Welcome to Market Catalyst. I'm Julie Hyman. We are 30 minutes into the U.S. trading day, so let's get to the three market catalysts we're watching this hour. First up, we'll have full coverage of the December jobs report and go live to Washington for a conversation with the Deputy Labor Secretary. Plus, Wall Street is bracing for a Supreme Court ruling on tariffs that could have big implications for markets and the economy. And we'll break down the biggest risks for investors to watch in 2026 on a geopolitical scale. All that and more coming up on Market Catalyst. So let's take a look at what's going on in the major averages right now. We have a rally going on, albeit a pretty small one. But right now, the Dow is pushing higher by more than 100 points, about 1/4%, fifth of 1%, call it. The S&P 500 up about the same amount. And the NASDAQ, though, up just about half that. And it's interesting to see the equal weight index up about 1/2%. We'll have more on that in a moment, but I did want to check on some of the other asset classes in the wake of that jobs report that on the one hand was positive with the unemployment rate ticking lower, on the other hand was negative with jobs increasing less than estimated. And we should mention on the economic data front, we had housing starts coming out much weaker than anticipated. And just now we have preliminary January consumer sentiment from the University of Michigan coming out a little better than estimated at 54 versus the estimate of 53.5. So we'll continue to watch the vibes from that and how that feeds through the market. We've got the 10-year yield up a little bit here this morning, just 2 basis points, 4.2% is where we find the 10-year yield here as investors weigh the outlook for the Federal Reserve, which doesn't seem to have changed much for January. A cut is not expected for January, but we continue to watch that. Bitcoin, little changed here this morning. Crude oil futures seeing a little bit of a tick higher here, up by 2.25%. And then let's check on gold, shall we? We just heard a conversation that Brian Sozzi did about gold, and we are seeing gold push a little bit higher this morning. Now, I mentioned that equal weight index outperforming, and one of the early emerging themes here, very early, because we're only a few days into the new year, but one of the early themes is that we are seeing some broadening of the rally, some rotation into some of the groups from last year. So here's what it looks like today. Utilities are doing the best today, and that's as Meta has signed a new nuclear power deal with Vistra, Oklo, and TerraPower. So XLU, the utilities ETF, trading up by nearly 2%. Industrials, materials, and real estate are also gaining today. And then if you look at the year to date, and yes, I know the year to date is only a few days old, but still, it's interesting to see that we've got materials, energy, and industrials and consumer discretionary up the most. Communication services down this year thus far, and then tech up only 0.4%. So is this going to last? I don't know, but it's interesting to see that we've got that little bit of a mini trend that we are watching here this morning. And of course, we're also watching the economic data. So let's get more on that now. The December jobs report out this morning showing 50,000 jobs were added last month. The unemployment rate ticking lower to 4.4%. For more, let's send it over to Yahoo Finance's Jennifer Schonberger. She's joined by the U.S. Deputy Labor Secretary Keith Sonderling. Jen?
Thanks, Julie. And Mr. Secretary, thank you so much for joining me. Welcome to Yahoo Finance.
Thank you for having me. Happy Friday.
Happy Friday. Happy Jobs Friday. What really stuck out to me from this employment report was, yes, payrolls were light, but the unemployment rate dropped to 4.4% as the labor force participation rate held steady. Does this signal to you that perhaps we are at an inflection point where the slowdown in hiring could be turning, or the fact that we saw downward revisions again for both November and October, a trend that we saw over the past year, is that a warning sign that we are in a hiring recession?
Well, look, what we look at the Department of Labor is positive job growth. 50,000 new jobs, exactly in line with what expectation was supposed to be. And if you look at the year of 2025 as a whole, it was positive job growth. And that's what the president committed to, turning around the economy, to putting the American workers first by creating opportunities for them. And that's exactly what we saw in this job reports and from the whole of 2025. But specifically to this, unemployment rate ticking down, wages up, inflation down. And that's what we're very excited about there heading into 2026, where we think the economy is going to continue to take off. Job openings are going to continue to increase across all sectors. And what I'm focused on particularly here in the Department of Labor and in this administration is when those jobs come, because we know they're coming, is to have the skilled and trained American workforce. So those jobs are going to American workers first.
We had positive job growth, yes, over the past year, but despite the one big beautiful bill, which has incentivized corporate investment, incentivized job creation, seemingly 90% or nearly 90% of the jobs that we saw created over the past year has been notably in healthcare and social assistance. Why haven't we seen more private sector jobs created across more sectors at a stronger rate, or is that just yet to come?
Oh, it's coming, and the American worker wants those jobs. A lot of the industries that have left, that have been offshore, are coming back with some of the president's historic trade deals and investments into this country. Where are those going to go? Those are going to go to creating new manufacturing plants. Deprived industries are coming back, but first, it needs to start with the infrastructure. It needs to start with building and construction before those jobs come. So, as the investment flows in, we're just making sure here at the Department of Labor that the American workers have those skills, and we're making historic investments to make sure that's occurring. Whether it's an expansion of traditional registered apprenticeships, whether it's for workforce Pell Grants. The most important thing for us is to have those discussions with the private sectors who are getting those investments, who are making those investments, to make sure that when the jobs do come, that there's workers. And that will continue to have the unemployment rate go down and jobs opening increase in those sectors outside of what we've been seeing now in healthcare.
And to your point of laying the groundwork, investing for future job growth, a new survey out from the New York Federal Reserve says that sentiment for finding a job right now has dropped to the lowest level since 2013, when they started tracking sentiment. What do you say to those Americans who are looking for work as you are trying to lay the groundwork here?
Well, like the Department of Labor has been working on, we're about to enter the golden age for the American workforce. And we're working on plans to help skill those workers so their sentiment improves, so they know that they have the underlying skills for all these new jobs that are coming and are being created currently. So that's really a big focus of ours. And I think the more we make investments in the American workforce, the more that sentiment is going to increase, because frankly, in prior administrations, those investments were not going to the American workers. And that's why we saw that foreigners were getting a higher job growth rate than native-born Americans. And that flipped, which is exactly what President Trump promised. In the first year, the net job gains were all to native-born Americans. And that is a big change, and that is really going to help that confidence go up. But look, as we see now in the market, and the other statistic that we just heard before we came on, sentiment is going up into this year. GDP is going up. Inflation is going down. Wages are going up. Everything is pointing into the right direction, which is exactly what President Trump promised.
Yesterday, Treasury Secretary Scott Bessent says the White House has done its part to lay the groundwork for economic growth, investment in this economy, but the Federal Reserve needs to do its part, and the administration has been harping on the central bank to cut rates. We saw the Fed cut rates 3 times at the tail end of last year. Has the Fed done enough at this point to support the labor market?
Well, the president, Treasury Secretary, and this administration has been clear that rate cuts need to happen. And as those continue to happen, as we've seen, we're going to continue to see more jobs, more job growth, wages going up, inflation continue to go down. And those GDP numbers continue to be forecasted to increase. So we're very excited to see that when those rate cuts occur, which is what you're hearing should happen.
And before I let you go, Mr. Deputy Secretary, the Supreme Court, as early as this morning, is expected to rule on whether President Trump's tariffs issued under those emergency economic powers are legal. If the court were to strike those down, what impact could we see on the job market?
Well, we're confident, this administration, in the legal arguments and President Trump's authority to do so. However the Supreme Court rules, I can assure you that the president, the Trade Secretary, Treasury Secretary, Commerce Secretary, Labor Secretaries have a plan to make sure that trillions of dollars of investments will still come into this country, which is just going to lead to continued job growth and opportunities for American workers that they've been deprived of.
Mr. Deputy Secretary, thank you so much for joining us today on this Jobs Friday. We so appreciate it. Hope you'll come back and see us soon.
Thank you.
Julie, I'll send it back to you in New York.
Thanks, Jennifer. Mizuho is downgrading American Homes for Rent and Invitation Homes to neutral from outperform after President Trump announced he plans to ban institutional investors from buying single-family homes. Joining me now, Handel St. Just, Mizuho America's senior a real estate investment trust and home builder analyst. Handel, thank you so much for being here, because this is a bit of a confusing situation, I think, for some investors, right? President Trump, comes out with these pronouncements. Then we have to figure out, how is it actually being implemented? Will it actually be implemented, and what effect it will have? So I know part of that is your job to figure all of this out. So how are you thinking about those issues and whether this is going to have an impact?
Absolutely, and thanks for having me. So yes, needless to say, the tweet on Wednesday was a bit of a surprise out of left field. Certainly wasn't something that we, the analyst community, investors, even the companies, were expecting. And when we step back, certainly feel it's a bit of an existential threat to the business model and growth prospects. So lots of uncertainty near term as to what you alluded to, the timeline, what ultimately gets implemented. Right now, I think there's a bill that's recently proposed in Congress by a Republican senator from Ohio to codify the proposal. But what comes next, the timeline, look, Trump's going to be at Davos in a couple of weeks. There's a State of the Union. We expect to hear more on this. But in the near term, we felt going to the sidelines on these stocks made sense.
So the business model of these companies, just to be clear, for people who are watching at home, at what kind of cadence do they buy homes? So they buy them and then they rent them out. But in what volume are they typically buying? Because this order, if it does go into effect, seems to imply they can keep the homes they own. It's just a matter of the ability to buy new homes.
Absolutely. And that's an important point. The second point you made, I think Treasury Secretary Bessent walked back some of the threat yesterday by saying that there won't be any forced liquidations. But going to the initial part of your question, look, these were companies born out of the great financial crisis. There was a significant amount of buying back during the middle and latter part of the prior decade. That's slowed in recent years. These companies aren't buying as much as they had been 7-10 years ago. Now, part of that is because the opportunity has waned. There's not as much homes for sale in the MLS inventory. Home prices have recovered quite a bit too. So some of the returns have been interesting. In more recent years, they've been buying more directly from home builders. But if you think about this business model over time, a good chunk of their growth is going to come from internal operations. They can generate 3 to 5% of what we call same-store net operating income per year when you factor in revenues and expenses. But the external growth is, to a degree, largely tied to acquisitions. Now, certain companies, American Homes for Rent, is an active developer, so that's another question. Will they be able to, and it seems so far that that's the case, be able to continue to develop and add homes to their portfolio? But the other company, Invitation Homes, is not an active developer yet, and so I think for them, it's a bit more of a direct impact to their capital deployment. These companies have also gotten into third-party management in the case of Invitation Homes, lending, but acquisitions had been a key piece of the business model for years, have slowed. But as we think about the forward prospects, certainly something that's now off the table.
And Handel, as you point out in your note on all of this, professional investors, institutional investors, put another way, own about 3% of the overall single-family housing stock. So in your assessment, has their ownership increased the pressures on affordability in the housing market, either on the owner side or on the renter side?
So I think overall, as you pointed out, it is a small number of the overall national market. But if you think about where the footprints of these companies are, largely in the Sun Belt and concentrated in cities like Atlanta, where professional or institutional landlords are closer to 10% plus of the stocks of single family homes in those markets. So the overall stats, on a national level don't look to be as meaningful, but, it does look a little bit different when you focus in on the markets where they're most concentrated, the Sun Belt, which is where the opportunity was greatest following the great financial recession. And so I think at the margin, it's not a big number, but when Americans, young couples, go to buy homes in a number of these markets, there hasn't been much availability in prior years. And when they go to the process, oftentimes they're beaten to the finish line by institutions who can buy cash, who can do underwriting more quickly. And so the opportunities you think about over the longer term for young couples, young adults to generate a nest egg via the value appreciation of a home in some cases has been, taken away. Now, that's not to say that the opportunity still isn't there, but it just makes it a bit more challenging at the margin when there are corporations actively bidding in markets where there hasn't been as much inventory.
That's really helpful context, particularly that focus on the sort of regional versus the aggregate nationally. Something else I wanted to ask you about, Handel, with regard to this market is the other measure that the president has talked about, and that's Fannie and Freddie buying some mortgages, some $200 billion in mortgage-backed securities out of the market, which he hopes will bring down mortgage rates. And Fannie and Freddie do some of these operations already. And so I'm curious how you're thinking about that potential effect.
Well, to be fair, that's a little bit beyond my purview. I understand the impact certainly is, in the desire of the administration is to make homes more affordable. To one degree, bringing rates down, but also increasing the availability of homes, which is part of, I think, at the heart of this ban on institutions. So I think for the administration going into midterm elections, obviously affordability, inflation, all these items are front and center. And certainly, I think a very important political point for a number of folks running for office. And so I expect that, these issues will remain front and center. We'll hear more initiatives, but ultimately, I think something needs to be done here. Obviously, there's a lot of folks who are just simply purely unable to buy homes. And we think about what the single family rentals, just to tie them back into, offer. Look, one of their talking points is they can offer a quality home for Americans at a price far below the cost of ownership, on average $900 a month in their market. So that's meaningful. So something clearly needs to be done on the affordability and the availability side.
Handel, really interesting perspective. Thank you so much. Appreciate it.
Thank you.
We got much more markets action ahead. Coming up, we'll talk about the upcoming Supreme Court ruling on tariffs. The Supreme Court is not releasing a ruling on President Trump's tariffs today as the court still weighs the legality of the duties. Here to discuss this and much more is Eurasia Group founder and president Ian Bremmer. And Ian, I know this week you were also out with your top risks for this year. We're going to get to that in a moment, but had to ask you about this first. What do you make? We were all sort of waiting for it to happen today, this ruling potentially to be handled down. Looks like we're going to have to wait a little bit longer. But how should we be thinking about what the Supreme Court may say, considering the administration seems well prepared for it?
Well, it is likely to be one of many constraints on Trump's ability to continue to use tariffs as his principal tool to project American power around the world. Another is the fact that the Chinese in particular have shown that they're prepared to hit the Americans back hard, and therefore Trump is tilting more towards trying to get to a deal, to get to yes to Xi, as opposed to forcing him to capitulate. You've got affordability issues driving political discontent with President Trump now, as opposed to being one of the top positives when he first became president for his second term a year ago, and the likely eventual ruling from the Supreme Court to constrain, at least in part, President Trump's tariff-making capacity using IEEPA to determine national emergency. You can't really, no jurist would make that sweeping claim in the way that Trump ask forgiveness, not permission, did originally. And so all of these things imply the U.S. is going to have more constraints on those activities going forward.
It's interesting, and I had a discussion with some market participants earlier who said, that even if some of the tariffs are removed, that the market's kind of priced it in already and adjusted. But on a company by company level, if there is more volatility to come on their operations, one would think that would have to, cause some hiccups, at least on that front.
Certainly, uncertainty is the biggest problem. They'd rather a lousy but stable operating environment than one that is all over the map that they continually have to reassess and replan for. But here we're talking, if it turns out, again, as we expect, that there will be constraints, it's very clear what the alternative tools would be for President Trump to impose tariffs, Section 232, others, and that, I think, limits the scale of uncertainty going forward, even though the initial reaction to the Supreme Court ruling will require big readjustments.
And all of this, of course, speaks to the risks that you just outlined this week in your annual list of top risks on a geopolitical basis. The number one risk is U.S. political revolution. What you said you referred to last year about as the rule of dawn. People are now throwing around the term Monroe Doctrine in the wake of Venezuela. And what's interesting is how curiously unaffected since Liberation Day, largely, the markets have been by all of this. What would change that, Ian?
These are long-term concerns for the markets, not short-term concerns. The fact is we have lots of conflict, for example, in areas that produce oil, but demand is relatively soft, and OPEC has about 2 million barrels off the market right now. So, it's fairly obvious that the bigger concerns of the United States saying we're going to change the political system internally and we're going to change the foreign policy operating principles externally, that President Trump said the only constraint on his action is his personal morality. I suspect a lot of allies of the United States do not see that as a significant constraint. Those things are going to have very big long-term impacts in not only how the world is ordered, but all capital moves, how supply chains are formed. And definitely if you are a big multinational corporation investing for 10 years and longer, a time frame which is considerably longer than Trump is going to be president, these things are massively uncertain and they are affecting your decisions. But we shouldn't see that have an impact on short-term investments in the markets.
Yes, and we've talked about this theme before, certainly, as well. I am curious, as we see this remaking, what does it say about the soundness of the U.S. democracy at this point? Because of some of the changes that President Trump has made, from influence on the media in some cases to public ownership of individual companies, for example, as well. So what does it mean about the character of our democracy?
The politicization of the Department of Justice and the FBI to be loyal to him as opposed to independently carrying out the rule of law. These all show that both norms and actual checks and balances that are codified in institutions on the president are weaker than they used to be. And Trump is a symptom of that, but he is also an accelerant of that process. That's what the political revolution is. So we know it's underway. And in many ways, we compared Trump to FDR, the other major revolutionary president in history. And in many ways, in Trump's first year, he's showing he's much more willing and capable to break these norms and checks and balances than FDR was over his 3 terms. So that's quite something. But ultimately, we do think that President Trump is likely to fail. Our confidence level is less strong than you would like it to be. But for 3 reasons, in ascending order of importance. First, because Trump is less popular than he was a year ago, and he's likely to lose the House in the midterms. And that is likely to have at least some impact on Republicans thinking he's a lame duck and starting to break away from him. We haven't seen that yet, but it is more likely over time. More importantly, there still are checks and balances on the president. You already asked about the Supreme Court, but we've seen court rulings, for example, stop Trump from his investigations that are politicized into Comey and Letitia James, prevent him from sending the National Guard to Chicago, for example. You still have a professionalized military that reports ultimately to the Constitution. And you also have a federal system of governors and states that run a lot of things in policy, including elections, and that matters. But the most important reason why the political revolution is likely to fail is because Trump is undisciplined. Because even though he says that the Democrats are his principal enemy and the adversary of the United States, and not the Russians, and not the Venezuelans, and not the Iranians, he is easily distracted. He is very impulsive, and he doesn't have a lot of policy expertise. So he's very willing to faff around in Greenland, where a disciplined president that wanted a political revolution, that believed that Biden had actually weaponized the system against him and was a mortal threat, would be spending all of his time and influence on power on destroying that other party and making sure that they have no chance to effectively run for leadership again. They'd be focused on shutting down the fundraising and shutting down the media and all of the things that one does if one wants to actually take control of the reins of the state. And Trump has really shown that even though he has that impulse, it competes with many other impulses. And so ultimately, as they say, sometimes it's better to be lucky than smart. And I do think that the United States falls increasingly in that category.
Ian, we could talk about that for the rest of the hour alone, but I do want to move to one of the other risks that you talk about, and it's the U.S. versus China, not necessarily on the tech front, which is what a lot of people talk about, but on the energy to power the tech front, which I thought was really interesting. You paint the U.S. as a sort of petrostate at this point, and certainly the Trump administration has leaned more into that, and China more depending on alternative sources of energy. I was struck this morning by Meta's announcement that it is partnering with a number of nuclear companies to buy power from them. So how do you see this playing out? Because it's obviously not clear, we're not just relying on petroleum here in the U.S., they're not just relying on alternative sources in China. So how does that all play out?
Yeah, of course, China today is the largest fossil fuel user still in the world. So, there's no question the demand is there. Texas still is the largest producer in the United States, not just of fossil fuels, but also of post-carbon energy. But the United States government has decided that solar and wind is woke. And so, therefore, they don't want to lean into it. They want to take away government support, and they want to lean into improving the regulatory environment for oil and gas and coal. And certainly you're seeing 13.5 million barrels a day for the United States. That's the largest production of any country in the world. And the fact that the Americans now intend to take over Venezuela with the largest proven oil reserves in the world, while China is doing everything they can to build the wind, the solar, the nuclear at scale, the batteries to store and transfer that power, and the infrastructure and the supply chain globally behind it. And ultimately, that's a 21st century system of energy, which is getting much cheaper with scale in a way that oil, gas, and coal are not. And China's exporting that infrastructure all over the world. So Trump can talk about the Monroe Doctrine, and America has military dominance in the Western Hemisphere, but actually China has stronger economic relations with almost every country in the Western Hemisphere, and they are betting much more heavily that they'll be more successful at it because they're going to be able to export 21st century infrastructure and likely the technology that runs on it. So that long-term is a very smart bet for the Chinese and a rather short-term bet for the Americans.
Does it matter, Ian, or how much of a disadvantage is it that, at least for now, the U.S. still has the lead technologically itself, when it comes to chips, for example?
I think it matters less if the Americans are going to have a hard time scaling it. Not only because the energy will eventually be more expensive in the United States, but also because those energy demands will compete between technology companies and farmers and consumers, voters. And I do think that in 2028, you're going to see political movements in the United States that are going to be very unhappy with a lot of the technology companies because they see affordability as a growing crisis, and electricity will be a component of that. You saw some of that in the New Jersey special elections for governor just over the past months, but that's just the beginning of this story.
And one of the other risks that you talk about, and this is kind of related to some extent with that, one of your risks, you say AI eats its users. Basically that it will be more of a destructive force than a productive force. What would that look like? How would that play out?
We do believe it's going to be a productive force. These are top risks we're focusing on, so we don't focus as much on all of the revolutionary positive potential of AI that is happening every day. And when you look at the industrial uses, the biotech, the medical uses, when you look at the national security uses, AI is really revolutionary. But here we're talking about the consumer uses, specifically that as these companies spending such extraordinary amounts of money are going to be squeezed by their investors to start turning a profit. And commercializing AI bots for consumer use means experimenting on the population real time to ensure that you get their data and that you get their engagement. And that's a really dangerous thing to do. We wouldn't do that with vaccines, even during a pandemic. We test them first to make sure they're safe. We wouldn't do that with GMO foods, even though people are starving around the world. You test them first to make it safe. But yet when we talk about AI and algorithms and chatbots, we actually test them on our citizens real time. And when that gets motivated by an urgent profit impulse, it becomes very dangerous for society and very dangerous for our politics.
Ian, we're seeing that, an example of that right now. Grok has been criticized for, sort of opening the floodgates of sexualized images, for example, AI created images, and has reportedly taken some steps to try to walk that back. Do you think that that there will be any regulation of these kinds of activities?
That's right. Test it first, real time on the population, and then walk it back after. And that is unique in our environment because there's no regulatory environment around it. Again, it's kind of astonishing that you let the kids engage with it. You let any adults. I mean, when you think about, we have people in society today that engage with you only to accomplish their purposes with no affect whatsoever, with indifference as to what it does to you, as long as they are making you happy to ensure that that engagement occurs. We call them sociopaths, right? And we do everything possible to keep ourselves and keep our children free of them. And yet that's precisely the way these AI bots are programmed in dealing with citizens. And we are waiting until the damage is done to say, oh, we may need to reprogram that. And it's the companies that are responsible for taking that decision themselves. There's no regulatory oversight. And in Europe, which had been trying to do the most, because they don't have the growth, the productivity, or the tech companies at scale, they're increasingly aligning with the American model, the Wild West, not the Americans saying we need to learn more from the Europeans in thinking about safety of the population.
Ian, it's always great to talk to you, if a little depressing.
Oh, it's not. I know you do. Okay.
Appreciate it, Ian. Thank you.
You get it. Yeah.
Coming up, we're live at the NASDAQ looking at some of the top analyst calls of the day. Stay tuned. You're watching Market Catalysts.
Welcome back to Yahoo Finance. I'm Brooke DePalma. We're live at the NASDAQ here in Times Square. Let's turn now to some of today's top analyst calls on Wall Street. Today, we're watching shares of Delta Airlines, FedEx, and Marriott. First up, Delta. Susquehanna raised its price target on the stock to $85. That's up from $70. Now, this comes on the heels of Bernstein and Deutsche Bank also raising their price targets on the stock earlier this week. The average 12-month price target is now at $78, and the airline is expected to post its fourth quarter 2025 earnings results on January 13th before market open. But we're also watching shares of Southwest because that stock got a rare double upgrade from JP Morgan. The firm upgraded its rating on the stock to overweight from underweight. Now, the firm cited that an increase in earnings per share guidance is likely, and that airline will report its earnings at the end of this month. It's also worth noting that JP Morgan raised its price target to a street high of $60, up from $36, and the average 12-month price target on Southwest is now at about $42 on the street. Next up, FedEx. Bank of America raised its rating on the stock to buy from neutral, citing the company's cost-cutting strategy, its upcoming freight business spinoff, and profitable share gains. It also raised its price target to about $365, up from $315, and there are now 23 buy ratings, 9 holds, and 3 sells on the street. And last up, let's take a look at Marriott, because BMO Capital raised its rating on the stock to outperform from market perform. The firm highlighted EBITDA upside from Marriott's upcoming credit card program renewals, plus called its royalty fee-based asset-light business model as, quote, very attractive. There are now 13 buy ratings, 15 holds, and 2 sell ratings on the street. Keep it right here on Yahoo Finance. We'll be tracking all the latest market moves and top calls throughout the session. We'll be right back.
President Trump is renewing calls for the U.S. to acquire Greenland. The president says his team is considering a range of options to make the self-governing Danish territory a part of the United States. Trump has cited the territory's importance for U.S. national security, but of course there are other reasons the U.S. may want Greenland, even though Greenland has said it is not for sale. Joining us now, Yahoo Finance's Jake Conley, who recently visited Greenland on assignment for Yahoo Finance. Jake.
Correct.
This is such an interesting story and speaks to why the U.S. might be interested in Greenland. You had exclusive access to visit a potential oil exploration site there. Tell us about what you discovered.
Yeah, Julie, this company called MarchGL right now, when it goes public via SPAC merger, probably end of this month, early next month, it'll be called Greenland Energy Company, led by a veteran oilman named Robert Price, who's been in this field for 40 plus years. And they started prospecting this site on this peninsula called Jameson Land off the eastern coast. Very, very isolated. The only way to get there is kind of a plane, boat, helicopter, ladder of journey, right? But I went up to Greenland on invite to go see the site. We got up there, we flew in the middle of the night from Iceland, and we did not actually get to go to their drill site because weather's too bad. Daylight's too low. They're in polar night now. And the Greenlanders will not fly in bad weather or the night just because of how dangerous the environment is, right? And how sketchy things can get. But it speaks to the operating difficulties. The US Geologic Survey puts Arctic oil at 90 billion barrels.
Wow.
These guys think on this Jameson Land prospect, they could be sitting on up to 13 billion, which would be the biggest find in the last decade.
By point of comparison, remind me how much the reserves under Venezuela are that we're talking about?
300 billion barrels.
300 billion barrels. Okay,
Right,
so
right.
so still smaller than something like
Yes.
that, but incrementally, potentially large.
And the difference you have here is that Venezuelan oil is all this really heavy crude we've been talking about, right? Really thick, hard to process. The oil that they're sitting on, they think they're sitting on this Greenland patch, is very similar to Brent crude in the North Sea. Light, sweet oil, really good for the market, and trades at a premium to pretty much every other grade on the planet.
So you didn't get all the way up to the site, but you did get to Greenland. You
Yes,
saw, some
yes.
of the operations. We're looking here at some of the footage, I believe, that you shot while you were there.
Correct.
Which again kind of speaks to the harshness of the conditions
Yes,
that
yes.
were there. What was it like being there, and what would it be like, for those who would be doing this kind of a work?
It's almost alien, right? You are so isolated from the surrounding area that, it's quieter, very little cell signal, very few people, and it gets frigidly cold. When we were there, it was hovering around the 10s or 20s, which is not horrible, but what you feel is the wind chill. In the winter, and they want to have crews up there year-round working, in the winter you get down to the 30s or negative 30s or 40s. Freezing cold temperatures that can get dangerous. That equipment you were talking about was supposed to be barged up the eastern coast to their drill site to start building a road to their inland drill site. But all the water is freezing, frozen over, so they can't move the equipment until May, which is going to compress all their timelines. Speaks to the fact that operating up there is really, really hard. It's why this hasn't been done before. You deal with weather, frozen water, dangerous storms, isolation. Everything is expensive, takes longer, more dangerous.
So why are they doing it?
They're doing it because there is opportunity, right? All the other major oil companies in the world, Exxon, Shell, BP, Eni, they've all gone and looked at Greenland. They've evaluated this prospect. There was a period in the 2010s where it looked like a lot of these companies were actually really going to start drilling. All of them pulled back because it's too hard. And the thing that Robert Price, the CEO of this company, told me is that his company is smaller. They don't have the shareholder responsibility needs. They don't have the dividend and risk profile concerns. So he's taking a risk here. It's a huge risk, but if it pays off, it could be a huge reward.
And they do have the go-ahead from the Danish Greenland government to do this?
Yes. Back in 2021, the Greenland government banned the issuing of new oil and gas drilling leases. However, there were 3 or 4 licenses that were operating then that were kept active. This company now has those and is using those licenses, kind of grandfathered in.
So it's the only company that has active licenses at this point?
That's correct, yes.
So let's bring it back then to Trump's quest to get Greenland one way or another. Does that also present a risk to this project? What would happen then?
It could. It's really hard to tell how the geopolitics could play out. Right now, Greenland controls its mineral rights. Greenland is an autonomous territory of Denmark, but it has the control over its mineral rights, what's sitting below the subsoil, right? So any oil, any critical minerals, as has been a focus, anything like that, Greenland has the right to. If there were to be a US annexation or something like that, what would happen to those rights would be in question. So there's just too many variables right now to say how the project would be impacted, but I think it's very safe to say there would be some impact.
Well, and one would think, I mean, and if this isn't too speculative, the fact that it is a US company going in and doing this would be helpful to avoid disruption potentially.
Yes, I think the Trump administration, and this is not confirmed, but I would imagine that they're looking at this project and saying this could be a potentially good thing, right? Because we have US presence. What's the thing that Trump has been harping on about Greenland? Security.
Right.
China and Russia are starting to use the Northern Sea Route as the Arctic ice melts, as temperatures get warmer. They've been building up military presence there, nuclear submarines, drone tests, things like that. Trump wants a US militaristic presence there. Having a US oil company there gives the US government another foothold to say we have real American presence.
And Jake, lastly, did you have a chance to ask the people there how they feel about all of this?
Yes, I did. It shocked me just how excited a lot of them were.
To have this development.
Not
necessarily to have the US take over Greenland.
No. This oil and gas development. And the reason is that the reason it's not a sovereign nation right now is because it gets $500 or $600 million USD worth of subsidies from the Danish government. Because Greenland itself cannot offset that money with its own domestic industry because they don't have heavy industry, right? This is still, for the most part, completely undeveloped land. Because those mineral rights are theirs, though, if any oil were to come out of the ground, they're going to get a percentage of that profit. And that could go toward a potential independence play and toward backfilling those subsidies.
And presumably would also create some jobs.
And exactly, and would create jobs, probably a lot of jobs. If you think about, let's say that Robert is right, 10 billion plus barrels of oil. That's not one rig. That is a steel city out of nowhere, right? That is ports, that's storage tanks, power plants, housing at mass scale, huge industrial operation. It's going to create a lot of jobs. And so the Greenlanders that I spoke with have been watching this really closely ever since the 2010s and actually really excited about the prospect of getting some of this money from their soil.
Gotcha. So interesting, Jake. We've been talking about this for a while. I heard all about Jake's trip, and you can read the full story on Yahoo Finance this weekend. That's when it drops with all the details on the trip and what this company's trying to do. Thank you so much, Jake.
Thanks,
really
Julie.
Appreciate it. That is it for Market Catalyst. I'm Julie Hyman. Thanks for watching. We've got more Yahoo Finance coming up.